Well, hello everyone, and welcome out to Quick Start Lab number 4 here in 2023. Very nice to be with you. Corey here. Andy could not be with us. He had a prior engagement. So we have the one, the only Noah Davidson joining today. How are you, Noah?
I'm awesome. I'm awesome. Excited to be here. I feel like I am joining this in session 4, so it's kind of like watching a show in season 1, episode number 4. I have a lot of
Yeah.
questions. I'm not sure where we are in the plot, but I'm excited to be here, and it's going to be awesome today.
Well, this is a big day for you being invited to the Quick Start Lab. I mean,
I feel
that
like I've
must
been
feel,
called up from the minor leagues to the big leagues. It's like I've been in D
yeah,
league, and it's like, ooh, hey, the big guys called me. Here I am. So.
Yeah, I think the Quick Start Labs is like, yeah, I would say the Mentor Club is the big league. So you're already in the big leagues. The Quick Start Lab is like batting practice or something, you know. So we
Oh
invited
yeah,
you
well
over
practice
here to,
makes perfect, right?
that's right.
So there you go.
Awesome. Well, welcome to the Quick Start Lab and hello everyone. So as is customary, usually we get people saying hello, and it looks like Noah's got a lot of fans out there, a lot of people saying hi, Noah, and welcome to the Quick Start Lab. So we've got some really good things going tonight. As per usual, we're going to do a little bit of a review of some of the concepts that we've taught to this point. We'll talk about how those trades are going, what's happening with them, what we might do at various points. We also have a little bit more information, some new material to go through. I don't want to introduce that yet because we'll kind of get to it as we go. But let's start here with a review of strategy. So remember our risk graph. In any risk graph, you have your profit and loss, and then you got your break even coming across here. And we started with a bull put credit spread. So we got paid a credit, we got paid money to do a certain strategy. And in that particular strategy, a credit spread is normally a credit because you're selling the more aggressive option, or kind of selling insurance in this case. We're saying we don't think the stock is going to be below this price. We are pretty confident it's going to finish above this. So we sell a put, we're basically selling insurance, but then we don't want to be naked on that. And so what we did was we bought our own kind of reinsurance policy, right? We reinsured ourselves. So we bought a lower strike put, and the difference in cost of these two puts creates a credit to our account. We collected money because we sold the more expensive, the more aggressive put, but we bought some protection down here just in case all heck breaks loose, the stock goes down too much. We want to have a limit on how much we're willing to lose. And so our risk graph for that particular trade, maybe we'll draw it something like this. The risk graph for that particular trade would go like this, something along those lines. Now I'll only draw it out kind of halfway here because in session 2, we added to this trade. Remember, this was on Oxy. OXY is the stock, right? So that's the first thing. We dealt with some puts and we did a bull put credit spread. Second class, we said, hey, Oxy's going well, the stock's going higher, we're making some money because we collected this credit and the stock's going the right direction. So we said, let's try and compound this a little bit and bring in another credit. Well, how can we do that? We did that by selling, again, sort of an insurance type contract. We sold a call, and then we bought a higher strike call because we don't want to make a naked promise. We wanted to cover or protect ourselves. And this is called spread trading, selling one promise, buying another to protect it. Now, this call that we're selling is not naked because it's protected and insured by this one. And so the difference between those, we collected a bigger premium for the option we're selling than we had to pay out for the option we're buying, which means, again, a credit, right? So we sold some insurance, so to speak. We bought some reinsurance just in case we were wrong, just in case the stock exploded too high. And that is called a bear call credit spread. And that creates a risk graph that looks like this. And so it looks very similar to this one, but opposite. It's over on this side, where if you think about the stock price, right, what hurts the trade, this is higher stock prices, this is lower stock prices. So this is like, let me think about Oxy, the stock's around 60. I think this was a 55 strike, if I remember right, and this was 50. This was maybe a 70 and this was a 75. I think that's our strikes, but we'll review. But anyway, the point being that if the stock stays between these prices, we have maximum gain. If the stock gets too high, 75 or higher, or too low, 50 or lower by expiration, then we have max loss. This is where max risk comes in, right? Max risk. And notice we have risk on both sides. We have risk if it's either one, if it's too high or too low. Now it can't be both. It cannot finish at expiration simultaneously up here and down here. That's not possible. The stock can not be two places at one time. It's either going to be at this share price that's hurting us here, this share price that's hurting us here, somewhere in the middle in here, and all of those create certain risks and rewards, max risk being way too high or way too low. So that's kind of the breakdown on this, right? And we know that this risk graph has now this strategy, these are two strategies combined together that create, what is the name for it? Who can tell me? Let's see who's quick on the typing here. You got it, iron condor. Jerome was quick on the trigger there. So now we're in an iron condor. We're not in a bull put or a bear call by themselves. We're in both, which is what an iron condor is. We could have done the iron condor from the start. It's a four-legged trade, right? One leg, two legs, three legs, four legs. You could put on the iron condor all at one time, or you could do what's called legging in, and that's what we did. We put on the first leg, or the first half essentially of the trade. So we legged in first half of the trade here. At a later date, we added the other leg, and now we've got the whole trade on. So good review of the strategies, good review of kind of the breakdown of what we're looking at here. And let's go look at this together. So if we come back over and we look at Oxy and we open this up, we can kind of see the strikes, and I remembered them correctly, okay? We have the 50, 55 puts, we have the 70 and 75 calls, right? Here we can see our profit and loss. Now, what is a profit and loss? Well, this says profit and loss open. This says profit and loss day. Now, why is this day empty? Because the markets were closed today, right? The markets were closed today, so there is no P&L for the day, but there is profit and loss here since we opened the trade. So this is what we would call, some places call this an unrealized P&L. An unrealized P&L means, well, this is where you're at right now if you want to close the trade, but it's still an open trade. It's still unrealized. It becomes realized when you close the trade or it hits expiration. At expiration, the trade would be done, or if you close it ahead of time. And we could close this at any time we wanted. Now, if we look at this P&L, you can kind of see where we're at. And I don't know if these are perfectly accurate. We'll take a look at it here. But it has us up about $240 in this particular position in the trade. So it says most of our profit is coming from the call side. And that's because the stock kind of tumbled back down a little bit the last couple of days, right? So the call side's doing well. The put side is now in a little bit of danger. Remember just last week, we were saying, well, the call side's in a little bit more danger than the put side. Now we'd say the opposite. Now the puts are in a little bit more danger than the call. That's the nature of a moving market. It can go this way, it could go that way. We're still somewhat in the middle, so we're sitting in a pretty good spot. Let's go look at this from the risk graph perspective. And so if we hit analyze, and we got to punch in that stock symbol, here you can see the breakdown. Now remember, we went ahead and did 5 contracts in this example. So we're trading the iron condor, but we're trading 5 times the iron condor. That means whatever the credit is, we collected that credit 5 times. Whatever the risk is, we have that risk times 5, right? So we usually calculate out max risk and max reward, and that's per contract. And in this particular case, if I remember correctly, you can see the prices here, but didn't we bring in $1.40 total for this trade? And since it's a $5 wide spread here, our risk is 5 minus the credit. So 5 minus $1.40 is $3.60. So we have $140 of reward potential and $360 of risk potential. But again, we did that 5 times. So we have that reward times 5 and that potential risk times 5. Let's see if our math checks out. I'm not going to look at it first. We're going to check our math. $140 times 5 gives us $700 of potential profit. $360 at risk times 5 gives us $1,800 of potential risk. So our risk, we could say, is, well, little more than 2 times our reward, isn't it? Now let's double check our math. If I cursor over here, you see down here in the blue, look at what it tells us. We make 700, 700, 700. That's if the stock finishes at expiration anywhere between 55 and 70. If this stock ends up, it doesn't matter, say the number, 57, yep, max gain. $60 per share, yep, max gain. 64, anywhere in there, we make 700 bucks. We make some profit, but not a max profit if it's in between the strikes and it's right here. So if it's sort of between, and we can set these price slices to break even at expiration, see that price slice and see that one. So now we can see where we'd be at between break even, which is at about $71.40, and $70. We'll make some money. If you look down there at this box, see how we're somewhat profitable? You know, 500, 400, 300, 200, 100, then we break even, and now we have 100 in losses, 200, 300, 400, 500, 600, and it keeps growing and growing and growing until, well, if we get outside of 75, we just lose 1,800 bucks if we finish out there at expiration. So you can see that. Same thing over here, essentially. We're up 700, 600, 500, 400, 300, 200, 100, break even, down 100, down 2, down 3, down 4, down 5, down 6, down 1,000, down 1,200, down 1,400, down 1,800. So it's good to kind of see that progression, and it makes sense that we're at a partial loss or partial gain in between the strikes, right? If we finish below 50, well, we would have max loss. So we've got to manage the risks both directions, in essence. If it comes to that, we don't want to do anything with this trade. What we really want is to just have this stock chop around in here like it's been doing, and we're already showing a profit because it's already wasting time in here. So we're already seeing some profit being built up, right? It said we were up a few $100 or whatever. That's if we wanted to go ahead and close it down. We have to be on guard against a big move that way or a big move that way in share price, meaning a plummeting stock below, 55, 54, 53. This is the danger zone, or a zooming higher stock above 70, 71, 72. This is kind of the danger zone. So when people say, well, where would you hedge and where would you protect this thing and so on? This is essentially that area. This is essentially that area where risk management comes into play. And we'll talk more about this. We kind of referenced, Noah, that we were trying to get in trouble with this trade. So to
Oh yeah.
catch you up,
I love getting in trouble with condors, especially in a virtual account, because it really helps you manage that risk when you get into a live account. I always like to start that hedge either based off of a technical price level on the chart or the minute it hits that strike price that you sold, either the call or the put. If it starts breaking above 70, I've got to be buying, because Andy and I will talk about this in the Mentor Club. We talk about the Bermuda Triangle where you're in that hope, and the trade's still in the profit zone, but you're getting awfully close to that break-even line. And if the biggest challenge, I think, with the Iron Condor, it's an amazing strategy and it works extremely well until it doesn't. And then it's a little bit like, the old stories about a frog in a pot of water. Like if you throw the
slow
boil,
yeah,
the slow boil, the slow cooker of pain. And I talk about this a lot in the Ultimate Adjustment and Repair Playbook, where psychologically I've done this, Corey. This is like I'm entering a confessional and you are my priest. I have let condors go to max loss.
Anyone that's traded them has been in that situation before.
Yep. And it's because I was in denial and I was hoping and praying that the stock price would drop back into the profit zone, and I didn't know what to do, and I got stuck a little bit like a deer in the headlights. And this strategy is so amazing because it's such a powerful ROI for capital used. Like you're making $1,700 or $700 profit on $1,800 worth of risk capital. That's huge ROI. But if you mismanage one of those and you lose 1,800, you just wiped out how many times does 700 go into 1,800? You just wiped out 4 or 5, winning trades if you just took one max loss.
Yep.
Yep.
And we did this, and oftentimes our risk to reward is a lot worse than this. Actually, we did this one.
This is like a
pretty aggressive.
When you told me that you were trying to get into trouble with this one, the return that made a lot of sense to me, because I'm like, this is a beautiful condor. What are the probabilities? 73% that you expire between the strike or between the break-even points?
But between the break-evens, yeah.
Yeah. So that very well means that you've got a, 27% chance of getting in trouble.
And what's crazy about that is it's already wasted some time. So we started with worse probability than that, of course, So we put this on. If you look at the shaded area, which is your standard deviation, when we first put this on, and even now, you can see the shaded area is outside of our strike right there. And we started it like that. We kind of said, hey, let's put one on that's aggressive so that we can teach that risk management. And so what I think by the time mid-March comes, we're going to have, this thing pushing us to our limits a little bit. And so, like Noah said, we're going to be able to go to our bag of tricks a little bit, open up the toolbox and do some hedging with this position.
Yeah. So we had a great question come in from John about what's a good rule of thumb for getting out. I have one hard rule that I use for my own risk management. I don't know if this is helpful or not. It's something that I found that works for me. Never, ever, ever allow the risk to exceed your 2 times your profit. In this case, you got a big profit. So your risk would be, your max risk that you could accept would be no more than 1,400 if your maximum gain was 700. But yeah, I try to also keep it around the average condor. So this one's got a really high ROI. Most of the time, I think I'm closer to 10% ROI.
Yeah, I mean it's
So
so let me explain that we would normally put on trades with higher probability. Remember, I talked about the teeter-totter effect, that if we want higher probability of success, we need to accept a worse risk to reward. And so we do that. We're willing to take that trade. We're
yeah,
willing to put on a trade that has 80 to 90 or even better percent probability of expiring worthless, which we don't even have yet in this trade, and we've been in it for a while. So the trade-off is, because we have that great probability, our risk to reward is kind of lousy. It might be $100 of reward for $1,000 of risk or something like that, you know. And
right.
so, like Noah's saying, his rule is if he brings in $100 credit, he never wants to lose more than twice that. So what would be his max loss? $200 in that case, right?
Yeah.
Two
And so
times the credit.
my rule is I tap out. Like if it hits, if
Yep.
I only could make $100 in the trade to begin with, and that purple line and it's dropping against me, and I start hitting that $200 threshold, I either have to tap out, adjust, or hedge. And the simple answer is tap out. Just if you exceed 2 times reward, exit and just be done with it. Because over time, if you have like 80, 90% probability of a win, you can afford to take a loss on 80, 10 to 20% of your trades, as long as they don't exceed 2 times, your reward average. Because then over time, like, out of 10 trades, you win 8, you lose 2, but you're still net positive, even with the expenses that you took on the trades that didn't work. And so there's some math involved with that, and you need to get familiar with what your typical return is on a condor. My rules are I won't pull the trigger on one, Corey, unless I can pull 10% on average. That's for
Yep.
typical stock. But at the
So
same point in time, that's sometimes hard to come by. Like you'll go look at a stock and try to model it out, and it'll only yield 7%. And so you're kind of faced never less than 5%. It doesn't make sense to me to do it.
mhm. And you can see here in this hypothetical, if he brought in $100 credit and he was risking $1,000, well, that would be 10%, right? So it would meet his requirement of at least 10% of what he's risking minimum, or never below 5%. So he'd say, well, anything below 50, I'm not even going to bother. I'm not even going to consider it, making sure you collect enough. And some people say, well, why even bother hedging? Why even bother protecting and doing some of those things? Well, think of it this way. If you have a trade here that you put on that has a high probability of success, and then it starts to go the wrong way, and let's say it's coming down this way. Well, what if this trade is going sour, but we could put on a hedge that goes this way and makes money? And so now all of a sudden, what I'm losing here, I'm making here, which means I've created something of, maybe not perfectly break even, but closer to a break even if my hedge works properly. What I'm losing in this, I'm making on the hedge, and therefore, rather than lock in a loss, I can potentially turn this trade into a better outcome. So imagine you had a 90% probability of success, and then you could turn some of those that went sour into break-even-ish trades.
Yeah.
Well, that can really help your scenario, your win-loss, your profitability overall, and so on. So why bother hedging? Well, because there's some reward potential in it. Another big reason is theta, is time decay. I think you're probably the same, Noah. Delta hedging to me makes a ton of sense when you have a theta positive trade, when you're making money from time decay. Because now I want to leave this option trade going because I'm making money from the time decay, right? So even if it's kind of coming in here, I know that I still have theta working. And so the instinct would be, well, I want to leave this trade on because every day that ticks away is a little bit more profit and a little bit more profit and a little bit more profit. I'm making money from some time decay. So if I can hedge off the delta, which again is the directional move that's going against me, create an offset in the delta that's hedged, but make this theta, 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 theta as it kind of bounces around in here. Again, that's a good thing. Now, it doesn't guarantee that that's going to work out every time. I'm just pointing out that there are some real advantages to being able to hedge, because now you get to keep the trade on and get that theta continuing to work for you into expiration, and I can hedge off the delta. I'd be less inclined. You will put on trades that are theta negative, where basically you're losing money from time decay. Okay. So we always say that, theta is always negative, but it's positive for the person that's short. Remember, in math, two negatives make a positive, right? So if I just went out and bought an option, let's just say I went out and bought a call, or I bought a put and I was just speculating, that I'm less likely to sit there and hedge day after day, because the longer I hold this call, the more time decay is just hurting me. So time decay is killing me. Maybe I can hedge off some of the delta risk, put a frowny face on here, but the time decay just keeps eroding day after day after day. So I'm just less inclined to hedge something where time decay is hurting me. I'm much more inclined to hedge something where time decay is helping me. And again, that will make more and more sense as you kind of work your way through these.
So I have a question, Corey.
Yes.
Because I'm coming into season 1, episode 4, and I'm not quite sure what part of the plot we're in.
It's actually, you're way behind, because this is like season 8 or
season 8.
7.
Yeah,
I don't know
no
how
doubt.
many quick start labs we've had, but it might be season 8, episode 4. So you're way behind, but yeah.
So I'm trying to play catch up, and I've got an idea of what the answer will be, of course. Where does the condor fit in the plot? Where does the iron condor fit in your overall approach to the market? Because like I noticed on this portfolio, you've got, big Berkshire Hathaway positions, you got a handful of stock positions, and then you got this condor cranking out time decay for you. Where does this fit in the plot?
Yeah, so this one would be a trader's position, right? You can have your investments, you can have your trades. This would definitely be in the trading side. So we are trading, right? And so it fits in this area. And unfortunately, this particular portfolio is maybe not as managed as carefully and as closely as is the Quick Start or the mentor clubs, pardon me. You guys go in there every single week. A lot of this stuff comes from our coaching. So we will teach in coaching. I do the weekly forums every Monday. So every Monday people spend, I want to say an hour, but once we get talking, it tends to be an hour and a half or so. But anyway, every week our coaching students come in with me and we teach new concepts. So my guess is that almost every one of these positions is from some sort of teaching moment. And a lot of these maybe started off as a covered call or some sort of strategy, and maybe the options expired and we didn't keep doing anything with it. So you can see here, though, Berkshire is a little different. You mentioned that one. This happens to be, not to like tout this stock or anything, but it happens to be personally my biggest stock position. And so it just kind of mirrors that in this. Now, I own more shares than 400 in my personal account, and I should be up more than $21,000 as well in my own holdings. But so this portfolio is not really a quick start lab or anything other than maybe an educational portfolio. So we just kind of mix and match and throw some stuff in there. And this is
Yeah.
my own demo account, but it would be in the trading side. And this is probably the only iron condor we have on in the trading side. All of the rest of these are some other strategy that we're teaching. Some of them are hedged. That particular position is, you can see it's delta negative, which means it's a bearish position. So we have a mostly bullish portfolio. We could kind of say, okay, this is bullish, this one's bearish, and the rest of these are bullish. You can tell by the delta. So that's a little trick there. And this particular trade, Noah brings up a great question. So let's just have some fun here. If we look at Chevron, Chevron's a good teaching moment. Chevron is a stock, it's an energy stock, of course, and it's a good example of something that happens in the market sometimes, where good news or bad news is often referred to by traders. They think in terms of, oh, this is good or this is bad. And that can get you into trouble. The way I teach it is that it's just news. It's just news, and it's not good or bad. We need to determine that based on price action, based on how the stock acts, and so on. And so I love the Chinese parable where the Chinese farmer, this is the way I teach this, is the Chinese farmer has a son and he has a horse, and the horse runs away. And the people from the village come to the Chinese farmer and they say, I'm so sorry, I heard that your horse ran away. That's terrible news. And he said, I don't know if it's good news or bad news. And then the next day, the horse returned and 2 other horses were with it. And the people from the village rushed up and they said, congratulations, now you have 3 horses. This is great news. And he said, I don't know if it's good news or bad news. And then the next day, his son went out to break one of the new horses and fell off and broke his back. And the people from the village said, this is bad news. We're so sorry. And he said, I don't know if it's good news or bad news. And then the next day, war broke out and they came to us. The leader of the military came to his house to get the son. And he said, well, he's got a broken back. And the people from the village said, oh, this is great news. He doesn't have to go into war. And this could go on and on and on and on, right? Where is it really good? Is it really bad? Well, I don't know if it's good news or bad news. It's just news, right? And we'll kind of determine that based on price action. So we consider this a market tell. And it's one of my favorite approaches to trading, which is when you think about trading, trading is unlike investing. In investing, I'm taking a position that I want to own forever, and I'm going to collect dividends and I'm going to cash flow and all those sorts of things. In trading, news comes into play, but anyone that's brand new to the market, this is one of the first mistakes you'll see them make, is they categorize the news and they say, this is good news, the stock has to go up. This is bad news, the stock has to go down, or the market has to go down. And that is a huge mistake. Like the Chinese farmer, it's just news. I don't know if it's good or bad. It's just news, and we'll figure it out along the way. And so think about it from the standpoint of stocks. When do you think that stocks hit their top? If a stock is going like this, and it ramps up, and then it gaps up like this, what do you think happens from there oftentimes? Can you kind of paint a picture of what often happens? Well, it's a top oftentimes, and then we kind of come and we go this way and so on and so forth, right? What was the news like on that particular day? Did the public say, did they rush to the Chinese farmer and say, this is great news, fantastic, of course the news would be quote unquote good. Whatever's happening within the company would be good. And oh, by the way, the earnings and all of the good things would probably be at their peak, because things go through cycles. You've heard of cycles, right? The economy would probably be booming. The economic news would be quote unquote good, and so on and so forth, right? And that's where things hit their top. If you think about the stock market, when does it top out? It tops out when everything is kind of priced for perfection and everything's good, but the future is going to be more bumpy down the road. And vice versa, if this stock is plummeting, and then it gaps down and so on, well, what's happening down here? And you look back and it hit its bottom and so forth, and it takes off. What's transpiring right here? Well, I'll tell you what is. To the public, it's a whole lot of bad. It's bad economy, bad stock, bad earnings, bad whatever. You turn on CNBC, they're filling your head with all these negatives, how everything seems like the world's coming to an end and stocks are never going to go up ever again, and so on and so forth. And so, again, it's just news. It's not good or bad, and it's more dangerous. And so, when you think about categorizing that news and that thought process, right, of good or bad, when there's really good news and a stock's been running higher and it gaps up, I would much rather exit and take my profits. Who's rushing in and who's getting out? Now think about that. There's kind of two groups. The uninformed, the less educated are probably rushing in on the quote unquote good news. The professionals are doing what? They're taking their profits, right? And vice versa, when a stock has been plummeting, gaps down, the news is horrible, the general public is capitulating is what they call it, where basically your arm is being twisted, you've had too much pain, you can't take the pain any longer, you say enough, no mas, I've had it, I'm done. They sell their stock. What should we be doing, right? We want to be more buyers or exiting our short positions, taking profits on the shorts. Maybe aggressive to go against the trend. Maybe you don't enter a new position, but you're definitely buying back your shorts, taking your profits, so on and so forth, right? So that's kind of the concept. And Chevron was kind of an interesting run. You saw the short position in Chevron, right? We had a negative, we had a bearish position. Look at this. Look at this huge gap up right here. Now, I didn't know on this gap up, it looks like it might be breaking out, right? The news was good, quote unquote, right, by the public. What was the announcement? They announced a massive, it was like a 50 billion or some odd share buyback program and a huge increase to their dividend and all these sorts of things. And then look what happened the very next day. Gave it all back. And that is what we call a market tell. The public got sucked in on the good news. It traded poorly. Where do you think this thing's going? Look at it go. Okay. Now, I'm not suggesting it's going down forever, but for a trade, that is how professionals kind of think their way through the market. Do you see it? We don't have to act on that very first day. We just kind of say, okay, it's already made its jump. It's already made its gap. I'm not going to come rushing in on the quote unquote good news. If you're piling in just because some news comes out that you think is good or whatever, you're probably getting sucked in like the general public. You don't want to do that. You want to kind of say, hey, the better trades are when there's quote unquote good news and then really bad price action. When it starts giving it back, this is where you say, nope, something's off. This thing is going lower. Or really, really bad news and it jumps down. And then the next day it jumps up sharply. And while the public goes, well, it shouldn't be doing that. Why is it going up? This is stupid. It had all this bad news. It's a market tell, right? It's going to keep going that direction. So that's better kind of way to think about the markets. You don't want to get sucked in. Like if you're listening to CNBC and you're kind of buying on all the good news and selling on all the bad news. My guess is that you're almost exactly backwards in many cases to what you should be doing. So you kind of flip that switch in your brain, and all of a sudden you're thinking better. You're going to start to see better profitability in your trading. Really fun idea and concept there for you all to practice trade here in the coming weeks ahead. So good stuff. Noah, you've got some amazing stuff for us today. Let me make you presenter.
Nice.
And I'm excited to go through this with Noah here. Let me make sure you're presenting. And Noah's going to teach us some new concepts here.
All right. You should be seeing my screen right about now.
We've got it.
Check out that iron condor.
Hey,
this is actually a piece of artwork that one of our members, one of the Cash Flow Academy members, sent me. It sent me a couple years back. But when you started drawing up the risk graph, I just pulled up the artwork because I like the rendition. You can see the risk graph in there.
Oh,
you
yeah.
You can imagine the little.
You can see the 4 legs, right?
Oh yeah, you can see the 4 legs, and you kind of picture like a break-even point somewhere in there. I didn't draw that very well. I'm clearly not the artist this guy is, but there is your iron condor.
Very cool.
Awesome. Oh well, that was a fun conversation. Let me get rid of this. So this is the Mentor Club Basic Portfolio. And I've kind of got this laid out into kind of core investment strategies down here. And these are our speculative trades. I'm calling it mad money. And then up here, I've got a portfolio hedge. So I thought we could take a minute and talk about the portfolio hedge. I just added some insurance to the portfolio on Friday. And I did that because as I look at the SPY, well, I like to look at the futures. I saw very early selling signs, and the insurance that I had on the portfolio, I had some portfolio insurance on for the previous months, just expired on Friday. So my insurance for the portfolio was running out. Plus, this is not much of a sell signal, but the market violated the 20 period moving average. And at the moment I put the insurance on, it was just testing that first little support zone right there. And so I was looking at that, and I did a whole series on this in the Mentor Club this week where I talk about it. I decided, oh, you know what? I don't know. I originally was thinking this market was going to break higher because I can't predict the future. I always am a little concerned about the downside of the market. And there's some broad market context, Corey, that led me to believe that this zone that was support back here could end up acting as resistance out here. And this might have ended up just being a bull trap where we started to see the market reversing. And the bull in me, the optimist in me, kind of thinks that's breaking up and going higher. The bear in my mind that never seems to go away just because I've been through a couple bear markets, Corey, and so I'm always vigilant, thinks that, oh, that resistance could hold and maybe the market sells, and I don't know where we're going to go. I honestly don't. But I was looking at the portfolio and was thinking, you know what, this would be a good time to add some insurance. And so the first thing I would say is, well, I've got all these bullish positions. These are mostly just stock positions, and I've had them uncovered looking for the capital gain, letting the stock prices rise. And I've been waiting for the market to lose some momentum to sell some covered calls on them to start increasing the cash flow. And so what I did on Friday was I thought, oh, I was looking at the market. I saw it kind of hanging out here at resistance, and just looking at that 4,200 and just wondering, well, is it going to hold? And if I decided to sell some calls out above resistance on the stock so we could get paid regardless. I should probably draw my dollar signs in green. They just feel better that way. But I'd like to get some cash regardless of whether or not this market breaks up or, runs sideways or runs down. I don't really know which way it's going, but I was worried about that stalling out. And so step one, I bought some insurance for the whole portfolio, a little bit, not a lot. And step two, I sold some covered calls for cash flow and almost enough, not quite, but to pay for the insurance for the whole portfolio. So here's what I did. I used a broad market ETF, the SPY, to create a blanket insurance or an umbrella insurance policy for all those stock positions. And if you kind of look through it, I've got 100 shares of Apple. I've got that I just wrote a covered call on. I've got 100 shares of Amazon that I just wrote a covered call on. I've got a couple hundred shares of this Anglo Gold. I'm still holding on to some ConocoPhillips that gapped against me, and this is the one bleeder in the account that's making me go, ah. So you were shorting what were we, Chevron?
Chevron, yeah.
Yep. I'm on the opposite side of that, holding ConocoPhillips, and kind of thinking to myself, well, the Bears are going to run out of gas here in any minute now.
Well, I have to tell you, I don't hate energy as far as.
I actually really like energy in the springtime. Energy in the springtime is one of my investment theses. We consume a lot of it in the summer, and there's this seasonal tendency for energy to go bullish between about February-ish and May. And it's not perfect. It's like out of the last 20 years, it's like 16 times or so out of the last 20 years. It tends to go bullish in the springtime. And so it's one of I always try to, get a little directional on energy in the spring. Most years it pans out. Some years you get taken out behind the woodshed and you learn that there's no such thing as a sure thing.
Yeah, and even within energy, you can kind of pick your spots, because where Chevron was a better opportunity maybe to see that opportunity to play it to the downside. Our first highlight here in the Quick Start Labs was a bullish position on Oxy, which is in the energy patch. So you kind of pick your spots.
Well, and I've got a handful of energy stuff here. I've got ExxonMobil, I've got ConocoPhillips, and I even speculated a little bit on Chevron. And I actually we did a fun little adjustment in the Mentor Club where we bought a call, and then it popped up that day you were talking about all the good news, and we sold a call and adjusted it, and it shows a loss, but we really actually paid for most of that with the adjustment we made.
Yeah.
So
and another thing is, if you think about where we talked about this all last year, because energy was just strong while the rest of the market was weak. And sometimes you can ask yourself, where is a bull market? What's in a bull market? And about the only thing that you can really argue is in a bull market is energy. You can't really say that tech's in a big bull market, or financials, or stocks, or bonds, or so many, certainly not crypto, but you could say the energy sector has been in a long-term, cyclical bull market cycle. It's having a little rough patch here, but it's still in its bull market cycle. Whereas, almost everything else, right, has basically broken out of the uptrends last year. Energy did not do so. So there's a reason we've kind of focused on that. And I certainly did all last year. We kept coming back to energy. And of course, that sector just kept booming. So if you were trading energy and like that sector, you were certainly rewarded for doing so.
All right. So before I lose my train of thought, we've got all these bullish positions, a couple of limited risk speculative stuff, nothing too big. These are very small positions. And then I bought that insurance to help me do a blanket insurance on each one of those. And what I did is we use this in Thinkorswim. They have this fancy tool called a beta weighting calculator. And what you can do is you can check the box and you can beta weight the portfolio against whatever instrument you choose. And so what you want to do is, and first let me define the word beta. Beta is a fancy word for how much does Apple move compared to the Standard & Poor's index? How much does Amazon move compared to the Standard & Poor's index? So I can take the list of our portfolio here. I'm going to actually take this and break this out. And I actually did this in the Mentor Club specifically this week. Click on the little icon up here to customize it, and I'm going to add a column, beta. And you can add this to your main layout. There's different ways, but beta, again, is just a measure of how much stock A moves compared to stock B, and usually the index. So now we've got this little beta column. And so here's Apple, here's the beta column, and it says 1.3. And so what that means is you can figure out how to do the math that for every $1 the S&P moves, Apple in theory moves 1.3. Amazon moves about 1.2. This Anglo Gold is moving about 59 cents on the dollar. Chevron's moving about $1.20, and so on and so forth. And what you figure out is, well, which of the stocks that we hold, which of these are more volatile than the market, which ones are less volatile than the market. And as you can imagine, a stock like Apple that moves more needs more insurance to protect it than, say, Rio that moves 69 cents on the dollar. It's just not as volatile. Or AT&T is about 61 cents on the dollar. They just don't move as much as the broader market. So beta weighting, the whole point of beta weighting is for you to figure out how much insurance you need, or how much risk. It's a better way to, I guess, define it is risk, calculating your risk and figuring out what type of coverage you need. So it's risk assessment. And when I check that little box, it says, well, okay, we're going to beta weight it, and you have to tell it against what. So that little box is blank, and I chose the SPY, which is the exchange traded fund for the S&P. And what will happen here is this is the current delta of the portfolio, 247. And as I hit enter on the beta weight, that number should change. So if I uncheck the beta weight, this is the beta, 1664. When I check the beta weight and put in the SPY, it adjusts my net delta down and says, oh, it's 247 when you compare it against to the SPY and how much that one moves compared to how all these move in concert. Does that make sense? Did I explain that well enough, Corey?
Yeah, sorry I was muted, but that's perfect. So
Okay.
yeah, your beta against the SPY, you're taking your portfolio, you're saying, how does my portfolio compare, my entire portfolio compare to this one product? And if I was to take all of my positions and stick them in a blender and mix them all up and then turn it into SPY, what would that entail? How much would it be? And that's kind of what it's breaking it down to. Perfect.
And so, yeah, right. So I'm looking at the market, and this was extremely, in fact, probably honestly a little hyperactive on my part, Corey. Taking this little tiny M for murder, that little cross of the 20 period moving average, the little 3-day selling that happened last week, and going, uh-oh, maybe they're going to sell. So this is extremely, what's that?
I like that. I like acting early rather than sitting and going, well, maybe I should, right? You could start small, even like with a smaller hedge, kind of feed it. If it's working, if it's not, get out real quick. Do some things like that, especially in the practice where you just get some practice in. But like with our Oxy trade, my guess is I'll start hedging that even before it gets us in. You don't want to be hedging after you're already in big trouble and you've got a big loss, right? So what Noah's kind of emphasizing is, hey, I'd rather be a little too early and maybe acting a little, maybe not off some big grandiose signal, taking a smaller signal and saying, hey, let's go ahead and act here, and then we can kind of work our way forward.
Yeah, so there's actually a little bit more to the story here. I, from time to time, overthink things, Corey, and I do some advanced technical analysis. And a long time ago, I learned Elliott wave theory, and I learned how to use those patterns. And it's an interesting concept. But here's the big picture. And the reason I probably started thinking, oh, I don't want 9, I wanted 200 here. Boom. 200-day moving average. So this is a weekly chart of the market over the last 20 years. And I noticed a little pattern here where the market came ripping down and hit that 200-week moving average. And then it rallied back up and it came into that first support zone. And this creates a little, I could go down the advanced rabbit hole and explain all the fancy patterns. The simple pattern is what's called the kiss goodbye. That first big support zone can sometimes act as a resistance zone. And so the way I think about it is like, this is an intersection And at the intersection, you have to be extra careful, because from here, if this ends up holding, maybe the market sells a little, maybe it sells a little more, maybe it sells a lot. I don't know. The market could just stall out here and say, well, I don't know which way I'm going. It could not make up its mind, or it could ignore that intersection, blow right through, and just take off to the races. It just happened to approach this intersection. So that, and this is the reason I went to this big long-term weekly chart, is I'm going to take you guys back in time to the year 2007-8. This is the same chart. I could probably squeeze this up to make the pattern match the drawing I just drew. Might take me a minute of manipulating the chart, but that's exactly what it just did, is the same pattern you see right here. The market went through a little sell cycle early on, went down a little bit, dropped, rally, came in and started up off that same 200-week moving average, started back up, came up into that intersection. Where here it was the floor, and there maybe, and I didn't know, and then the market got spooked, and everything got crazy and too big to fail, and panic and mayhem, and all it was me seeing the market in this exact same setup. Guaranteed, not a guarantee, void where prohibited, not valid in all states. I am not a prophet. I have no idea which way this market's going. I simply saw a pattern and said, you know what? I don't mind buying a little insurance.
Yep.
And so, whether or not this is smart or absolutely insane, who am I? I don't know. So I see that little pattern right there, and then I just see on the daily chart, just a teeny tiny bit of selling. For all the market probably just drops a little and finds support and heads right back up. It's probably fine. I don't know. So there's that first little signal.
Yeah.
I go, you know what? Yep. So I go, you know what? I'm going to add a little bit of insurance just in case it drops a little. And my insurance is probably only really good down into this little zone right here. It covers me a little bit. And I went and I picked up 2 contracts. But the reason I went through and did the beta weighting and measured it against the SPY is because the SPY, I can actually buy and sell the stock on that, the ETF, or it has options. And I used options. And so what I did is I went and I bought 2, these are just very short term, just to protect me for the month. And the 2 contracts cost, I want to say $800 or something like that, 8 SPY.
I'm going to guess $441 a piece.
You're right in that ballpark. You can see it right there. So yeah, $441 a piece. So 2 contracts, $441. You read my mind. You saw it on the screen, and there you go. We spent $441, and that gives us insurance, and it's just for 25 days or so. And it wasn't.
So you paid $882 to have that portfolio hedged up and protected.
Correct, against a short-term drop. And then if the market sold more, I'd buy more insurance. I don't like to run out and buy full coverage insurance. It's not like a car. Like my wife just recently got in an accident with her car, and we had a nice little bit of coverage on it. And so long story short, full coverage, low deductible, we got a new car. But with the portfolio, buying insurance all the time is an expense. It's a theta negative proposition. So we focus on theta positive, like selling covered calls, selling puts, riding iron condors, collecting cash flow, collecting positive theta positions, and buying insurance is an at expense. And so I tried to keep the expense low and only adding it when I get a sell signal, and buying it, I buy short-term insurance so it doesn't cost a bunch. Some people like to just go buy long-term insurance all the time. Like they'll go buy 6 months or even a year's worth of insurance and just keep the portfolio insured. But then it's an expense. It's a bigger expense, and it's like anything else in life. You buy a home, you buy the insurance. If you're going to invest in a stock portfolio, you buy some insurance on it. I try to reduce my costs just by only adding insurance when I see the market give me a sell signal.
I agree with you there, and I'll say the reason it's different is because there is the possibility of my house burning down and being zero. There is the possibility of my car getting totaled, right? The stock market, you can't if the stock market goes to zero, I don't think your insurance would be worth anything because the dollars probably collapse. I mean, the stock market will not go to zero, right? An individual stock could, but if we have a portfolio and so on, and so that's why I always look at it a little bit different. I think insurance makes sense at times, and it makes sense the way Noah is talking about it in my mind because we're at a key intersection and this
Right.
could be a big turning point. And so let me go to my toolbox, let me find some insurance because this is an area where we've been on a big run higher. Now the market's starting to roll over. Okay, I want to have some protection here for a little while. I don't
Right.
feel like it makes sense. And Warren Buffett, actually, with Berkshire Hathaway, if you read his annual letters, they're pretty interesting. And he talked about options because they trade options. And he talked about that put options are overvalued
Oh,
because,
almost always overvalued.
yeah, because people buy them nonstop for protection and speculative purposes. And his argument was, if we know that the stock market throughout his entire lifetime is constantly going higher, right? Not every day, every week, every month, or even every year, right? He's gone through big multi-year cycles where the market's going down. But if you take any extended period and you say, well, it's going to be higher, uh, 10 years, 20 years, 30 years, 40 years, then the idea of constantly buying all that insurance doesn't make a ton of sense.
Right. Oh,
And so that's
absolutely.
why they were big put sellers. If you remember in the global financial crisis, Warren Buffett was selling S&P puts and he had billions of dollars of risk out there. And he said,
Hmm.
I'm happy as can be because I know the market's going to be fine longer term. And guess what? It was, and he made billions and,
Oh, well, absolutely.
more.
So actually, I 100% agree. So here's one of the reasons I like to be proactive rather than reactive is one, right now, the puts aren't that expensive because it still looks bullish and the market's not really that nervous. But if the market were to start selling and it started heading south, then what happens is people get more and more nervous and the price of put premiums goes up and it gets even more expensive. And so one of the biggest mistakes I made early on, Corey, was when the market was panicked, I thought I need insurance. And I would run out and pay insurance, but I'd end up paying top dollar for the insurance to a guy like Warren Buffett who wasn't panicked and was just selling insurance and making good money because most of the time the market's going up. And I brought up that big chart, and you look back over the last decade plus, it went up. And if you go back over the last 20 years, like we have here, or I even go to like maximum max data available, the market on average is going up. Every once in a while, for about 18 months, it gets bearish. And maybe it lasts a short while. Maybe it's acute like COVID and then it's over. Or maybe it lasts, 18 months of bearishness. But then over time, everybody's getting up and going to work in the morning to get the value of their company to go up, right? So, yeah, it doesn't make sense to me to hold insurance long term or all the time. This context with that potential intersection of support resistance, and it also has to do with the Fed's raising interest rates. I think we got 1 to 3 percentage points to go before the Feds are done raising rates. That's my guess, based off of what I study, what I read, and what I look at on the economy. It doesn't mean I'm right. I could be dead wrong. And unemployment's still low. So the Feds have been raising rates trying to curb inflation. And I think there's more rate hikes this year. So my concern is, well, they're trying to bring asset prices down, which includes stocks. So I wanted to buy insurance while it was cheaper, and I only wanted short-term insurance just in case. And if Ed South, I buy more. So we use this volatility index. They call this the fear gauge, and right now it's at about 20. And on the hot, when the market panics and it goes south, this thing shoots up to 45, 50, 55, but it gets crazy high during big crashes. When the market's everything's good and everything's going up, the VIX drops all the way down to 10, and that means the insurance is everybody's happy. They're not worried about nobody's worried about the chaos and the storm when the weather's perfect outside. Everything's great. Right now the market's on it's tentative. It's not scared. It's not panicked. It's tentative. They're pricing in for the whole S&P index about a 20% swing in a year. Which, I mean, a 20% swing in a year, up or down, it doesn't say which direction. It's just kind of ballpark up or down. When normally and when the market's good, they're pricing in 10% swings. And when the market panics, they're like, 60% swing. They don't know. And so insurance premiums shoot through the roof. And that's why a guy like Warren Buffett wants to sell them. When the market's panicked, those puts get so expensive. Selling them's a pretty good business model. Being proactive right now, just kind of saying, yeah, the VIX is at 20. The market's a little nervous. It's not like, that dumb and happy like it is when it's at 10. There's some tentative buyers and sellers out there, and it's a mirror opposite of the S&P if you go understand it. Yeah. So that's why I like to be a little proactive. I typically buy maybe 1 to 3 months at a time, and normally I'm pretty bullish on the market in the spring anyway, just because it's part of a natural business cycle. It tends to do well in the spring. I use history to kind of give me an edge, but it doesn't have any predictive value. So
there is kind of that whole sell in May and go away, right? Most of the stock market returns are kind of early on, and then usually when things kind of slow down. And
stock market almanac. Like when I first started, I literally ordered a paper copy of the stock market almanac or whatever it's called, Trader's Almanac. And that's one of the first things that stuck in my mind was sell in May, go away. And that it's not untrue, but it's also like over the last 100 years, it's kind of true.
And it's definitely not perfect, but it kind of gives you, that's what seasonality does, is it just kind of teaches you a little bit of what's more common, right?
Right.
So good stock market returns early, and then things kind of get quiet and in the summertime, and then in the fall is actually when the markets have historically been most dicey. So if you look at the crashes, they all seem to happen around September, October time period. And then usually the market gets more optimistic and bullish late in the year and so on. So there's some seasonality. If you go back to that VIX chart really quick, you're buying insurance and kind of zoom in there. You're buying insurance about as cheap as it's been in a while. I mean, if you kind of look at that VIX here, we're down here at about as kind of the low points for the last year.
It's really the last probably year and a half. I mean, it was the last time it was this low was back in August, and then prior to that, last April. So and cheapest it's been in months.
Yeah, and the VIX is like Noah said, it's basically how much does it cost? How much fear is out there? How much does it cost to insure? How expensive are those puts in the S&P? And when you come up to a key technical level, a big intersection, when the news has been quote unquote bullish, right? The people have been clamoring for, oh, this is good news, good news, good news. And so the market's kind of at this point where the good news might be priced in. We're hitting some key technical levels. There's some exhaustions happening in stocks where they're kind of falling after that quote unquote good news. These are all signs that, again, I'm kind of the mindset that we came on in at the very first session and we said, what's your outlook? And Andy and I came up with basically neutral. And that was a few weeks ago. And I think the market is almost exactly flat from where it was our first meeting on February 6th. It's almost identical. So far it's been right. If you ask me though, where I am for the coming months, I lean bearish. I think that there's going to be another leg lower. I think there's going to be some more downside. I think the Fed's going to have to keep rates higher for longer, and there's some things we have to deal with where we're transitioning from these years of easy money and quantitative easing and money printing and so on. Now we're in a different cycle where we just can't do that anymore. Inflation has finally shown up after multiple years of deflation. It's become a big issue. It's the biggest risk to the Fed. All of these things are still in the process of playing out and being priced out in the market. So where I had been bullish for some time and then went neutral recently, I'm fast forward a few months, I'll speak for myself, I'm a bit more bearish. I like the put buy I like the protection there. I
Well,
think that makes a ton
eh,
of sense.
so here's kind of the funny thing. Did Corey and I, we talk, but we don't really talk about this stuff very often. Like when we get together, we're chatting about family, we're chatting. I think it's just interesting that we both kind of independently have maybe a similar outlook. I don't know. See, I've gotten to the point where it's really easy to get caught up into narratives and for me to kind of believe my own BS sometimes. Because I think I'm smart and I know how to analyze things, and it's very easy for me to talk myself into being bullish, bearish, or neutral. So it's nice to get a little echo chamber out there, and that's one of the reasons I love coming to something like this, is because it checks me against my own little bubble that I live in. And I don't know. The market could very well just maintain bullishness and shake it off. I mean, the unemployment's still at what, 3 point something percent?
Yep.
That's about as good as it gets. But at the same point in time, I don't want to brag, but I bought 2 cartons of eggs this week. It was only like $18 for 2 cartons, organic.
Well,
And
I'm going to put a big brag on you because I didn't buy any eggs, and you know why, Noah?
oh
We've
yeah,
got
yeah,
we've got chickens.
you
So
got chicken. So
now
and that,
Noah's more high end. He had duck eggs. I mean,
well, I
I don't
had
even
duck
know.
eggs until some sort of predator in the neighborhood got my ducks. So I have no ducks anymore. But I think with the price of eggs, that's one of those things where that's an economic indicator that has limited use. But when I go to the grocery store myself and I, buy a couple bags of groceries, I feel the price. I feel that inflation.
For
I think the
sure.
average consumer feels the inflation. And even though they're trying to get us to believe that, everything's great with the economy, I don't know. I think inflation's still there. And I think the Fed still are going to continue raising those rates just because inflation is still at what was the last report? 6.4, 6.5. Which over the last 20 years, that's a really high rate of inflation year over year.
Yeah, I think it was 6.4. The Fed's target is 2. So you're talking about, I mean, 3 times what they want it to be for the annual
Well,
inflation number.
yeah, and then historically, they've got to get the federal funds rate up above the inflation rate to turn it. And so
Yep.
that means up to potentially 3 more points in rate hikes up towards 6%. What's the federal funds rate at now? 3? 3 and
No,
3 and 4?
it's higher than that. What is it at? 4.7. What is it at? They just raised it up. So we could come over here to Forex Factory. Fed funds is at 4.75. Yeah.
4.75. See, that just tells you how long it's been since I actually track it all the time. I just have a terrible memory.
Yeah.
Yeah. So and Andy and I will pop open this Fed Watch tool, and there's an 81% chance right now that you're going to see a 1/4 point rate hike. There is an 18% chance that they're going to do a 1/2 point rate hike. When I checked this last week, it was closer to like 90-10. And the headlines I was reading are the people are afraid that the Feds are going to have to do more aggressive hikes. But either way, the forecast is they're probably raising a 1/4 point, maybe a 1/2 point. And when's the next meeting? To March 22nd. March 22nd. So that, and I don't know how high they're going to go or what they're going to do. And the funny thing about it is it's like you said, it's just news. And the market puts its own little spin on that information and reacts to it. And then they pay more attention to the rhetoric than they do anything else.
Yeah.
And so the market,
it gets priced in. It gets priced in many cases ahead of time, right? Because if they kind of say, okay, the Fed is raising, and then we figure that they're going to stall out at about this interest rate, well, they're going to price that in ahead of time, well before the Fed gets to that finish line. They're going to say, well, here's where rates are going. We need to make these adjustments. Here's where stocks should be priced. And so in many cases, by the time the Fed's putting the finishing touches on those rate hikes and so on, where they've been hiking, and now they're, maybe putting the last 1 or 2 on there, the market might already be rallying where it had tumbled before. And that's exactly what you saw. Early in the cycle, the market was tanking last year. Why has it been rallying this year? Well, we already knew the Fed was pushing a few more rate hikes. So it had kind of been priced into the
It's
markets.
priced in, yeah. And so
But
I don't know. I think on average the market's an optimistic outlook, with
yep,
the exception of when it gets spooked. And there's usually some sort of contagion or catalyst or bad news that would cause the market to do something that's statistically on the outlier, like the black swan type event. And that I think is the impossible thing to predict. So I don't. Again, I'm not really predicting anything because I've learned over the years I am a lousy predictor. But I can anticipate and take small proactive steps. And whether that's, speculating bullish or speculating bearish or buying insurance on the portfolio, those are the things that I do to kind of protect the big picture. But the core stuff, I don't rely on prediction. I just rely on fundamentals and assets I want to own and dividends that get paid and stuff like that, because over the long haul, it's far more sustainable than trying to predict what the market's going to do next week, next month, next year. Who knows?
yep, agreed. And we actually, I did a coaching forum today. And we talked about that very thing. What I call, it's so much easier to know what is going to happen than when it's going to happen, right? We can kind of see that, okay, here's what is transpiring, but to try to pinpoint, oh, the market's going to go down tomorrow we can't predict all the little intricacies, right? But we can get most of the wins right. Or pardon me, the what's right. This is what should transpire. This has a higher probability of transpiring. This stock has a higher probability of doing this. The when part is what's difficult. So that's what I was teaching the coaching students is, well, here's how best to trade it. Give yourself some time for it to play out. Then you don't need to be right instantly. You just need to be right overall. If you're right, you make money. If you're wrong, you lose money. That's the way it should be. But I don't need to be right tomorrow. I can be right anytime
Right.
between now and the coming months and so forth. So very cool stuff.
Well, it is fun stuff. And the other reason I like the idea of buying some portfolio insurance just for the short term, I got a month left of ski season and there's this big storm coming, and I don't want to have to sit in
Nice.
front of my computer and pretend to predict anything. I just like to buy a little bit of insurance and then, go do something more fun.
You
Um,
like to have that theta paying you while you're out there chasing
Oh yeah,
storms. I love it.
absolutely. So that's the other thing I did. I said I did my insurance in two phases, Corey. I
Yep.
bought insurance and then I did really low, not aggressive. I just went and sold out of the money calls on my stocks, like Apple. I sold a call. Dow. I sold a call. Foot Locker. I sold a call. These are all stocks that I believe are still bullish potential. Fundamental, pay dividends. Just sold out of money covered calls, and they gave us enough premium to pay for the insurance, the puts. And so, just to put it into perspective, I just sold one on Amazon. I collected $500 on Amazon, sold 425. So I collected 425 on Amazon, and on Apple, I picked up $1.61, so $161 on, and I add another one or two of those in there. I actually collected more in premium than the insurance cost. And overall, I've got a little bit of negative theta short term, but I've got more positive theta working for me. And so it overall just kind of batting down the hatches on the portfolio. And this stuff, it takes time to get to where you operate at a level of sophistication. And you probably are a lot more sophisticated than I am on these things, Corey. Or maybe I am overly, thinking about these things. But I like to get my insurance paid for. And I like selling calls when I don't have big upside belief in the market. If I think the market's going to run, I don't mind capital gains. I like to uncover things and let them run, and try to focus on the cash flow when I don't have big bullish expectations for the market. So that's kind of
Yeah,
where I'm at and kind of how I think.
it makes a ton of sense. I mean, I manage very similarly. I really try to kind of think my way through the markets and just kind of figure out, okay, what is more likely? What are good levels to do this or that? I try to keep the blinders on and not get sucked into all those emotional trappings like we talked about with the news and buying on good news and selling on bad news and so on, where that's counterintuitively, that's oftentimes the exact opposite of what you should be doing. So great lesson there. Let me jump over. take this back
You
from
should
you here,
steal
Noah.
that back from me, and you should never ever let me have that much screen sharing time.
No, that was they're clamoring for more. Are you kidding me? They're like, I saw
Well,
the
you guys
comments in
definitely
here.
check out the Mentor Club for sure. This
Well,
week it's a fun one. So.
Cosman says, I like this, guys. It's like a free extra mentor club session. So, I mean, we got fans of Noah. There's no doubt about that. So I had to pull this up when Noah was talking about going and buying a couple of cartons of eggs. Look at the January. So eggs have come back down, but look at the spike in January, a 70% increase there for a period of time. Now, this just says eggs. I'm assuming duck eggs have got to be what, plus 150% or something. I mean, I don't know how much duck eggs would go for, but you better get those ducks back. We've got a bunch of people telling you how to keep the ducks safe. So maybe that's something that we can take a look at there. But this speaks to inflation. This speaks to prices. You can see that there was a little bit of deflation in a few items. So television prices, used cars and truck prices down, computers. So you can kind of see where prices are staying steady, prices are going down some, or prices are going up some. And it kind of gives you a nice little breakdown there of how inflation came in last month. And like Noah said, about 6.4%, still too high and still something that the Fed is battling with. So let's take this lesson that Noah taught and let's have a little bit of fun with it. We'll do a paper trade together before wrapping up. So if we take this little portfolio, which is heavily weighted towards Berkshire for sure, but if we beta weight, just like Noah taught, to SPY, it says, hey, you have delta in the portfolio of 591 positive delta. That's adding all these up. But what it really equates to when compared to SPY is about 281 SPY delta. That's what it is. So if we wanted to completely have an offset, if we wanted to go what's called delta neutral, what does that mean? That means that if we wanted a truly hedged, completely portfolio, that we would need to buy basically puts or short SPY, create a bearish position to the tune of negative 281 SPY delta. Basically, we could go out and short 281 shares of SPY. We could go out and buy puts in the SPY and buy enough of them that added up to negative 281 deltas. That would get us what's called delta neutral. Now, delta neutral means that basically your portfolio is on ice. It's not really making anything. It's not really losing anything in terms of the delta. And I would like that a whole lot better if we had more theta and stuff. We haven't been messing with this too much recently in terms of kind of showing some of those things. But let's come over here and let's just at least buy a put in SPY for insurance purposes, kind of show you. And actually, let me take a step back. We did buy a put in Oxy, didn't we? We didn't buy a portfolio hedge, we bought a stock hedge. So let me come back. This was our quick start lab. And last time we bought a little protective put in Oxy where we just said, well, what if you had done one of our first lessons of buying the stock, or we showed an example of what if you just bought the stock and generated dividends? What if you bought the stock, generated dividends, and sold monthly covered calls? And then last time we said, well, what if you own some of the stock in either scenario 1 or 2, you could buy a protective put, right? So let's go check in on that one first. That would be a good review. So if we come over to Oxy, check this out. We bought the May, what was it? The May 60 strike put. Let's see how it's doing. Let's check in here. What's the May 60 strike put going for? As of Friday's close, it's going for about $4.50. Do you see it there? you see that if we split, we call it the midpoint. If we split the bid-ask spread, 445, 455. So it's going for about 450 is the midpoint. Well, check this out. It's going for $450. We paid $335 for it. So that protective put's working out for us, isn't it? We paid $335 for insurance, and it's gone up to $450. So we have what's called an unrealized P&L, or our open P&L, and that is plus 115 bucks, right? We paid 335 and it's gone up to 450 per contract. So that's a quick little review there of that put protection we bought on that. And we'd expect something similar out of SPY, if not guaranteed. Now, let me make sure that everyone understands, if the market goes screaming to the upside and SPY does this and blasts off to the upside, well, our puts are going to go where? We're going to lose money in the hedge. Now, our portfolio would be going up, but this insurance would be going down. We think there's at least I don't know what the probability would be, but we might be leaning towards thinking there's a better than 50% chance that the market's going to tumble here for a while. So maybe we'd come over and look at some January puts, buy a couple of months of insurance. SPY is trading at 407. We could come in and just buy, let's buy one put or something just to show, and it's going April 400 strike put. It's going for about 900 bucks for one of those. Okay, let's do an example here. I just want one put at the 400 strike. This protects me if it falls below 400. And if I don't know if we could get the midpoint, but that's $906. Let's analyze this. And here's what it looks like. Basically shows in this graph that if you buy this put, what happens? You spent $906. So by spending $906, what do you think our risk is? What's the worst that can happen? If you said minus 906, watch this. Minus 906, minus 906, minus 906. It doesn't matter how high the stock goes, does it? If it goes this way, SPY is climbing in share price. We're going to end up, if we still own it in April, down $906. The insurance would be worthless at April expiration if the stock's above 400, and therefore we would have lost 906 bucks, as the risk graph shows. If the stock falls, look at what starts to transpire. Do you see this? Let me change the color here. It's not a very good color to show up. Do you see this line that just keeps going that way? I won't draw it right on top of it, but look at that line and look at the potential. Now, it's not going to be worth $10,000 unless the market really cracks and really, gets hammered in epic proportion, but could happen. But here you can see that if we land here, we're up $1,200 bucks, and if we land here, we're up $1,400 at expiration, and $1,500 and $1,700 and $1,900 and so on. And the worse the stock is, the worse the market's getting hit, the more money we're making on that put. So in essence,
well, I really like this, Corey, for a couple of reasons.
Yes.
One, I love that you're going a little longer term at April. That makes more sense to me. But two, go, if you don't mind, I don't mean to steal your train of thought, but go, if you look at the chart of the SPY and you kind of think about, well, what is it likely to do in a month? Well, okay, if it were to drop between now and April on the low end, maybe it's that first support zone around 380. Maybe it gets really beat up and drops to like 363. I mean, that would be like, a rough go for the market.
Yeah. And we can kind of draw some of those levels that he was talking about. Like here's maybe a little support level, and here's maybe a little support level, and really having some understanding of where you might even take the protection off. Like if you thought, hey, this support is holding, I think it's going to hold, and we're bouncing up off of it, and we think it's going to recover. These could be areas that we could take it off, and kind of areas that the market could fall towards. Indeed.
Yeah. So, and then I like to look at the risk graph. Like, okay, well, what if it dropped to 380? What if it dropped to 370? What kind of protection do you get? And
and then you look back here and you go, okay, well, at 380, we'd be up, $1,000, $1,100-ish dollars, and at 370, we'd be up about $2,000 in the position, maybe just over, maybe even 2,100-ish in profitability at those levels. So very cool. And you'd have to think of it this way as well, in that if this is working, so if SPY is going down, we can make an assumption. Remember, SPY is the S&P 500. There's 500 stocks inside of SPY. It's Apple, Google, IBM, Exxon, Chevron, Dow Chemical, you name the sector, like JP Morgan, Bank of America, Citi. All of these companies are in the S&P 500. So if the S&P is going down, causing this put to go up, what do we think our portfolio is somewhat doing? It's probably somewhat doing this, right? It's somewhat getting hit. Now, maybe it's a little better. Maybe we pick some better stocks than the S&P. So maybe it has a little bit more flatness to it, hopefully, to where this is kind of, maybe the market's going down more than our portfolio is. But the point being that if you own some stocks, you own some investments, you are probably getting hit on one side, but you're making something on the other side. And that's hedging in essence. Some people say, well, why not just dump all your stocks? Well, there are stocks we want to own for the long term, and we're not trying to pinpoint every turn. And if I sold, then I'd have to pay tax and on the capital gains, and then I can't generate income from covered calls and collect the dividends, and it just becomes a mess from the investing side. We certainly are not constantly moving in and out and in and out. So if I want to hedge my portfolio, I can add this, which will offset periods of time, and it works wonders, right? Because if my portfolio goes down here, but I make money on the puts, and then the market turns around and it goes right back up, but I locked in profit here, I just put money in my pocket from the drop, and now the market recovers and my stocks recover themselves, and now they're not down anymore, but I made this money while the market was soft. So you can be strategic and work your way through. So we'll go ahead and let's transmit this as a paper trade example, and we'll come back and check in on it. But if I was to confirm and send, it would say $906 at risk. Okay, that's how much I can lose, paying a 65-cent commission because it's only one contract. That's pretty standard. Your commissions should be in the neighborhood of about 65 cents per contract. It's kind of a standard rate right now, I would say, in that ballpark.
Well, you probably need to negotiate those down because very few brokers offer that rate up front.
That's true.
They'll charge you like $10 for the ticket and 65 cents a contract until you call them.
They will charge you as much as they can get away with. Yes. That's exactly right. But it is maybe not as well known that there is some negotiation available with most brokerages. In fact, Thinkorswim, as part of Ameritrade, they'll start you higher. Call them and say, hey, my buddy uses them. These people use them. They say I should be paying 0 ticket charge, 0 commission for stock, and 65 cents per contract. And they'll probably say, okay, we'll do that for you. So they want your business.
I could tell you're an Interactive Brokers user because you said transmit when you were talking about buying. And over the years, that's the #1 leverage tool I've used for negotiating commissions is you name drop Interactive Brokers.
That's right.
And say, oh, well, I could just move my entire account over to Interactive Brokers. They'll give me, this rate. And they'll be like, oh, no, we don't want you to move your money.
Yeah.
Yeah, stay here. We'll give you that same rate. So.
Yeah. And it's interesting. Interactive Brokers for years and years and years was the lowest commissions, and now the entire industry. So pretty much you can trade stock for free, zero commission, and most brokerages available out there, which is just astounding. I mean, remember we used to celebrate. It was like, I remember back in the early 2000s when Scottrade was $7 to
Oh yeah,
trade a stock,
$7.95. It
and
was
we were like,
$7.95.
this is
Yeah.
amazing. Are you kidding me? I only have to pay $7 every time I buy and $7 every time I sell. This is going to be revolutionary. And little did I know that they didn't even need to charge me $7. They could have made money charging $0 because they make money in a variety of other ways. And so commissions, that's the good news. Commissions have come down. Now zero commissions for stock, commissions for options, exceedingly low. But if you're paying, multiple dollars per contract or anything like that, a negotiation should be had. You should be paying less than that. So good stuff. Anything else? Any final thoughts, Noah?
Well, one, that was a lot of fun.
Yeah, it was.
You stick a quarter in me or in Corey, you'll easily get a great return on that investment. Two, if any of that felt like it was over your head or a little too advanced, don't worry about it. Go back, watch the replay, glean what you can from the information. Some of you kept up, and some of the questions and comments that were coming in, I was kind of monitoring the questions, and they're following along, keeping up great, no problem. But yeah, just keep plugging away at it. That's kind of the point. Repetition, repetition, repetition. You picked up some good lessons tonight. Very valuable stuff. And I always enjoy hanging out with Corey because he's such a phenomenal teacher, and just breaks it down real simple. I particularly enjoyed the news portion when we were talking about just news and some of that psychology and story. That was fun.
It was a lot of fun. We need to maybe have a trifecta. Maybe we go, I don't know, that might be too many voices, but me, you, Andy, I mean, the amount of terrible jokes that could be told with the three of us together, that could be phenomenal.
It could be. And I feel like I'm better behaved when I hang out with just you, Corey, but if I'm with
Yeah.
Andy, I tend to, drop my guard a little bit more, and I'm so used to telling bad dad jokes with Corey.
Yeah. Kings of dad jokes for sure. So great fun, everyone. Thank you so much for the comments. I mean, the comments are just overwhelmingly positive, and we just love and appreciate all of you. It's so much fun to be together. I think you can see that we care about you. We want you to succeed. We genuinely celebrate in your successes. We want you to go about things managing risk the right way, being bigger than your money. That's one of the biggest lessons. I mean, Andy's been a huge mentor to both myself and Noah. And it's just, again, the psychology, being bigger than your money, not being greedy, not doing things that you really shouldn't be doing, just to try to chase a dollar or something like that, but go about things the right way. And as you do that, there's just a certain, call it karma, call it blessings, call it whatever you want. There's certain things that you kind of put out good into the world. Good tends to come back towards you. And we wish you nothing but success and nothing but good in all that you do. So I thank Noah for joining us today. On behalf of the Cashflow Academy family, thank you for joining us here. We are back, let's see, Wednesday morning, February 22nd, 11 a.m. Eastern time. So we'll be back in 2 days. Have a great rest of your night. Good evening, everyone, and we'll see you next time. Goodbye, everyone.